$2,910,000,000. Gone. In a single trading day. That's what happened on March 4th, 2026, when the world's largest gold ETF, the SPDR Gold Trust, ticker GLD, recorded the biggest single-day cash outflow since 2016. 25 tons of physical gold ripped out of the vault in just 7 days, the sharpest weekly liquidation in nearly 4 years. And while that was happening, while big institutional money was rushing for the exits at a pace that hasn't been seen in a decade, the CME group quietly did something that almost nobody in mainstream financial media stopped to actually explain. They hiked gold margin requirements to 9%. For the third time in less than 2 weeks. And if you're sitting there thinking, okay, those are just some numbers, what does that have to do with me? I need you to stay with me for the next 20 minutes. Because this combination mass institutional selling happening at the exact same moment that the exchange is cranking up margin requirements, this is a pattern. A very old, very predictable pattern. And every single time it has played out in history, the people who understood what was actually happening came out on the other side in a completely different position than the people who didn't. Let me give you the landscape first, because context matters here. Gold right now, today, March 14th, 2026, is trading at approximately $5,020 per ounce. That might sound like a lot, and it is. 1 year ago, gold was around $2,800. So we're talking about a metal that has essentially doubled in price in 12 months. It hit an all-time high of $5,594 on January 29, 2026. Then, in what Bloomberg described as its sharpest single-day drop since 1983, gold lost nearly 10% of its value in one session, falling from above $5,500 to around $4,700 in a matter of hours. And right in the middle of that carnage, the CME announced margin hikes. Not once, 3 times in less than 2 weeks. Now, I want to be very precise here because the specifics matter. On January 13, 2026, CME made a structural change to how it calculates gold and silver margins. Before that date, margin requirements were set as fixed dollar amounts. After January 13th, they switched to a percentage of contract value. So instead of saying, you need $10,000 to hold this contract, the new system says, you need 5% of whatever this contract is currently worth. And here's why that matters. When gold is at $5,000 an ounce, and your contract covers 100 ounces, a 5% margin means you need $25,000 just to hold the position. But when gold was at $2,800, that same 5% margin only required $14,000. So the capital required to stay in the game automatically scales up as prices rise, without the CME having to announce a single thing. That structural switch was the loaded gun. The margin hikes that followed were just pulling the trigger. And here's where we need to talk about something that might feel technical at first, but I promise it clicks into place very quickly. What actually happened when CME raised that gold margin from 8% to 9% on February 6th? Imagine you're at a poker table. You've got a big stack of chips, most of them borrowed from the house. You've been on a hot streak, the cards have been going your way, and you're up big. Then the house comes around and says, hey, from tomorrow morning, the minimum buy-in just went up 20%. Some players at that table can reach into their pocket, pull out the extra cash, and keep playing. But some players can't, or won't. And those players have to fold. They have to sell their position to raise the cash to meet the new requirement. Now picture that happening simultaneously to thousands of traders across the entire gold futures market. That's a margin call cascade. That's what you saw play out in gold and silver from late January into early February 2026. It wasn't a change in the fundamentals of gold. The mines didn't suddenly produce more. Central banks didn't suddenly stop buying. The geopolitical situation didn't magically resolve. What changed was the capital requirement to stay in the paper game, and that forced a wave of selling that had nothing to do with what gold is actually worth. I'm not asking you to take my word for it. The gold analyst team at goldsilver.com wrote about this explicitly. The January 2026 silver and gold correction was structural, not fundamental. Margin hikes increased the capital required to hold leveraged positions, and when highly leveraged traders receive margin calls, forced liquidations cascade and prices drop sharply. Quick note for those watching who haven't subscribed yet. My analytics tell me about 3 out of every 4 people watching this right now haven't hit that subscribe button. If this kind of deep dive analysis is helping you cut through all the noise, I genuinely appreciate the subscription. It tells me who the committed community is, and it helps get this content in front of more people who actually need to understand what's happening in these markets. Okay, back to the pattern. Because here's the thing, this exact playbook has been run before. Not once, not twice, 3 documented times in the modern era of precious metals markets. And every single time, The setup looked almost identical to what we're seeing right now. The first time was 1980. Silver had exploded from around $6 an ounce to nearly $50, an eightfold increase, driven partly by the Hunt brothers, who were accumulating physical silver in enormous quantities, and partly by genuine inflation fears after a decade of monetary expansion. The market was heavily leveraged. Speculative fever was everywhere. And then the commodity exchange, the predecessor to what is now the COMEX, started hiking margins. Repeatedly. Within weeks, silver crashed from $49 all the way back to $11. Over 70% wiped out. The Hunt brothers went bankrupt. And here's what's critical. Silver's fundamental story didn't change. Industrial demand was still there. Supply was still constrained. But the paper market had been deleveraged by design, and the price followed the leverage, not the fundamentals. The second time was 2011. Gold had run from around $900 in 2009 all the way up to $1,923 by September of that year. Silver had gone from $18 to $49. Sound familiar? At the peak, CME raised silver margins 5 times in 9 days. 5 times. Prices collapsed. Silver lost nearly 50% from its high within 2 months. Gold pulled back from its record and spent the next 4 years grinding lower. Again, the fundamentals hadn't changed. The US debt was still exploding, the Fed was still printing, but the paper market had been reset. Forced selling had overwhelmed the price signal. And the third time is what we're living through right now. Gold from $2,800 to $5,500. Silver from $30 to over $120. CME hiking margins 3 times in less than 2 weeks. And on March 4th, a nearly $3 billion single-day exodus from GLD. We are in the middle of the third act of a play we have seen before. The question is, do you know how this act ends? Now let me walk you through the specific mechanics of what the CME actually did and when, because the timeline tells a story. December 12, 2025. The CME raised silver margins by 10%. This was the first warning shot. Silver at this point had already surged from $30 to nearly $60 over the course of the year. The move barely registered in the financial press. December 29, 2025. The CME raised margins again across the board on gold, silver, platinum, and palladium. That's the second shot. Gold by this point was trading above $4,500 an ounce. Silver had pushed past $80. At the same time, the Shanghai Futures Exchange adjusted its daily price limit for gold and silver futures to 15% and raised its own trading margin requirements. January 13, 2026. This is the big one that most people missed. The CME switched from fixed dollar margins to percentage-based margins across COMEX 100 gold, COMEX 5000 silver, NYMEX platinum, and NYMEX palladium. Gold was set at 5% of contract value, silver was set at 9%, palladium at 11%. The financial analysis platform Finimize described this as making margins more automatic, meaning every time gold prices rise, the capital requirement rises with it, without any announcement. This was the structural change that amplified everything that followed. January 29th. Gold hits its all-time high of $5,594. Silver peaks above $120 an ounce. Leverage positions are at historic levels. The market is, by any measure, stretched. January 30th. The CME announces another round of margin hikes, effective after market close on Monday, February 2nd. Combined with the nomination of Kevin Warsh, a known inflation hawk, as incoming Federal Reserve Chair, which spooked investors about the future of easy money policy, this was the detonator. February 2nd. Gold loses nearly 10% in a single session. CNBC reported it as the sharpest one-day drop since 1983, a 43-year record. Silver falls 15% intraday before partially recovering. Gold has now lost roughly $900 from its January 29th peak. February 6th, the third hike. COMEX 100 gold margins move from 8% to 9%. Silver goes from 15% to 18%. This is the confirmation that the exchange is in active deleveraging mode. Now here's where it gets deeply interesting, and where I want you to really focus. While all of this paper market chaos was unfolding, something very different was happening on the other side of the world. The People's Bank of China extended its gold purchases for the 15th consecutive month in January 2026. 15 consecutive months of buying. Even as prices climbed above $5,000, even as Western paper traders were dumping, China wasn't selling. India's gold ETF market saw the equivalent of $560 million in inflows in February alone, bringing net 2026 flows to nearly $20 billion. According to the World Gold Council, Global gold ETF holdings hit a brand new all-time high in February, reaching 4,171 tons, even after the January sell-off. Let me say that again. Global gold ETF holdings hit an all-time high. At the same time that institutional investors were pulling nearly $3 billion out of GLD in a single day. How is that possible? The answer is geography. Western institutional money, particularly UK-based funds, was selling. The World Gold Council's data shows that Europe was the only region to record outflows in February, driven almost entirely by heavy redemptions in the first week. The UK alone accounted for $1.9 billion in outflows. But North America recorded positive inflows. Asia recorded inflows for the sixth consecutive month, bringing in $2.3 billion in February. The East was buying what the West was selling. And that, my friend, is not a coincidence. Stick with me here because this next part is critical. The narrative being pushed in mainstream financial media around this sell-off was essentially, gold got overextended, traders took profits, the market is correcting, everything is fine. And there is a surface-level truth to that. Prices had been climbing almost vertically. Some consolidation was inevitable. But when you look at the actual positioning data, when you look at who was selling and why, you see something that doesn't fit neatly into the healthy correction story. According to data from the Crux investor analysis of the late January sell-off, gold and silver markets are now heavily intermediated by banks, ETFs, futures markets, and algorithmic traders. When volatility spikes in this environment, market makers reduce the size at which they're willing to quote prices, spreads widen, and price gaps appear. Ola Hansen of Saxo Bank was quoted saying, "Volatility feeds on itself. When prices swing too far too fast, banks and brokers step back to manage their own balance sheet risk. That retreat makes the move worse. It triggers stop losses, margin calls, and forced selling." And in silver, something particularly notable happened. Futures and ETF volumes actually fell as prices dropped. That's a sign that liquidity was thinning precisely when it was needed most. It's like trying to bail out a flooding boat when someone just removed the bucket. The initial catalyst for the sell-off? According to multiple analysts, it came from equities specifically, a sharp repricing in large-cap tech stocks. Microsoft fell more than 11% in a single session, their worst day since 2020, despite reporting stronger than expected earnings. That triggered a broader risk-off move, and because gold and silver had become part of a momentum-driven trade involving crowded positioning across multiple asset classes, the metals got dragged down with everything else. Not because of anything fundamental to gold, but because the same traders who owned gold also owned tech, and they needed to raise cash fast. Now let me show you the disconnect that should be keeping every serious investor awake. On the paper market, COMEX futures, ETF shares, derivatives gold, was being sold aggressively. Prices were falling. The GLD was hemorrhaging. But what was happening in the physical market? According to Brave New Coin, COMEX warehouse stockpiles were dropping to alarming lows. The World Gold Council reported that central bank demand alone was 230 tons in Q4 2025, a year of what they called durable buying activity, even as prices hit record highs. JP Morgan's Gregory Shearer said in their 2026 Gold Outlook that quarterly investor and central bank demand is expected to average 585 tons throughout 2026. To put that in perspective, demand needs to exceed about 350 tons per quarter just to push prices higher. 585 tons is 67% above that threshold. You have 3 consecutive years where central banks bought more than 1,000 tons of gold annually. You have the US dollar's share of global foreign exchange reserves falling to its lowest level since 1994, around 40%. You have gold's share of global reserves rising to its highest since 1991, around 30%. You have mine supply that cannot be ramped up quickly. Gold mines take years to bring into production, and yet the paper price was crashing. The screen was saying, sell, while the physical market was saying, there isn't enough of this to go around. One of these markets is lying, and I think you already know which one. Here's where I want to name some specific numbers and let you draw your own conclusions. At gold's January peak of $5,594, a COMEX 100-ounce gold futures contract was worth $559,400. At the new 9% margin rate, a trader needed to post roughly $50,000 in collateral to control that position. But at that same moment, leveraged traders, hedge funds, prop traders, algorithmic systems were often running positions many times larger than their capital base. When the margin requirement jumped from 8 to 9%, the incremental cost sounds small. But for a fund running 100 gold contracts, The additional cash requirement could be millions of dollars, required overnight. You either find the cash or you sell the contracts. And when thousands of traders across the system face that same calculation simultaneously, the result is what we saw on February 2nd. Deutsche Bank reiterated their $6,000 gold price target on February 2nd, 2026, the same day of the near 10% crash. Societe Generale raised their year-end target to $6,000, saying it may be conservative. Goldman Sachs and JP Morgan are projecting an average around $5,055 by year-end. Phil Strebel at Blue Line Futures, BNP Paribas, Citi, ANZ, every major institutional voice is pointing higher. Not because they're gold bugs, but because the structural math, de-dollarization, central bank demand, real interest rates, U.S. fiscal trajectory, geopolitical risk hasn't changed. A margin-driven forced liquidation in the paper market doesn't alter any of those fundamentals. Now let me tell you what this means for you personally, and I'll be as direct as I can while being clear that none of this is financial advice. I'm not a financial advisor, and you should do your own research and consult a professional before making any investment decisions. But here are the practical realities you need to understand. First, paper gold and physical gold are not the same thing. This correction proved it again. If you hold GLD, you hold a claim on gold that an institution manages. When institutional funds need to raise cash for margin calls or redemptions, they can sell those shares regardless of what you want. The price of your paper gold becomes hostage to the leverage decisions of people you've never met. Physical gold in your possession doesn't get margin called. Second, percentage-based margins mean the new CME framework will automatically require more capital as prices rise. This is structural, not temporary. Every rally from here will face increasing capital pressure on the leveraged futures side of the market. That means more volatility. That means more violent corrections punctuating the broader uptrend. If you're going to be involved in gold futures or leveraged ETF products, you need to size your positions with this reality in mind. Third, the geographic split in demand is the most important signal in this market right now. Western paper hands are selling dips. Eastern physical buyers, central banks, Indian retail investors, Chinese institutional funds are buying them. That dynamic has been consistent for 3 years. The trend is your friend until it ends. This one shows no signs of ending. Fourth, watch the CME margin page. This is public information. You can go to cmegroup.com and see the current margin requirements for gold futures in real time. If they hike again significantly, especially if gold is approaching new highs, expect the leverage flush to follow. That's your signal to expect volatility. Fifth, watch the GLD flow data, published by the World Gold Council on a monthly basis. When North America goes from inflows to outflows, that's a warning. When Asian flows diverge positively from Western flows, that tells you who has conviction and who is trading momentum. Sixth, the dollar share of global reserves and the Fed rate trajectory are the two macro levers that matter most beyond CME mechanics. The USD share of reserves is at its lowest since 1994. Markets are currently pricing in at least 2 Fed rate cuts this year. Each cut reduces the opportunity cost of holding gold, which historically correlates with ETF inflows and upward price pressure. And seventh, perhaps most importantly, understand that we are living through a historic repricing of monetary credibility. The U.S. national debt is north of $36 trillion. The 10-year Treasury yield is hovering around 4%. Real yields are positive but constrained. Multiple central banks, not just China but India, Russia, Eastern Europe, the Middle East, are actively reducing their dollar exposure and increasing their gold exposure. That's not a trade. That's a structural shift that plays out over years and decades, not days. Let me bring this full circle because I opened with that staggering number $2.91 billion out of GLD in a single day, and I want to make sure you understand what that actually represents in context. That outflow was largely European institutional money, primarily UK-based funds, reacting to a margin-driven cascade that was triggered by a percentage-based margin system that the CME implemented less than 3 weeks before gold's all-time high. The selling was real. The price drop was real. But the cause was mechanical, not fundamental. And the institutions who bought that dip, the Asian central banks, the Indian retail investors, the North American funds that actually added to positions on January 30th, the day of the crash, those are the players who are positioned for what comes next. The pattern from 1980 and 2011 tells us something important about what happens after these deleveraging events. Both times, after the margin-driven forced selling cleared out the weak hands and the leveraged speculative positions, the metal found a floor and eventually resumed its fundamental trend. In 1980, the fundamentals had genuinely deteriorated. Volcker hiked rates to 20% and broke the inflation cycle. The conditions that drove gold actually changed. In 2011, the same thing happened. Real rates rose, the dollar strengthened, and the fundamental picture shifted. But right now, in March 2026, what has fundamentally changed? Rates are expected to be cut, not raised. The dollar's reserve share is falling, not rising. Central bank buying continues at historically elevated levels. The fiscal trajectory is getting worse, not better. The geopolitical situation, the Middle East conflict, the energy market disruption, the de-dollarization trend is intensifying, not resolving. The margin hike deleveraged the speculative paper market. That's done its work. What it didn't change, what it couldn't change, is why gold went from $800 in 2009 to $5,500 today. Now here's a question I want you to sit with, and then I want to hear from you in the comments. The CME is an exchange. Its job is to manage risk. When it raised margins 3 times in less than 2 weeks, it was following its stated mandate: normal review of market volatility to ensure adequate collateral coverage. That's what they said. And technically, mechanically, that's true. But here's what I want you to think about. The 3 previous times in history when we saw rapid, repeated margin hikes on precious metals, 1980, 2011, and now 2026, all 3 coincided with gold and silver prices being at, or very close to, all-time highs. All 3 were followed by violent corrections that shook out the speculative money. And in all 3 cases, the large institutional players with deep balance sheets, the ones who could absorb margin calls without selling, or who weren't using leverage in the first place, ended up holding assets at much lower prices than the speculative crowd that got washed out. Is that a coincidence? I'm not going to tell you what to conclude, but I am going to tell you that the evidence is in the documents, the filings, the margin notices published on CMEgroup.com, the World Gold Council flow data published monthly, the CFTC Commitment of Traders reports published every Friday. This is all public, all verifiable. None of it requires you to trust me. Gold is sitting at $5,020 right now as I record this. It's down roughly $575 from its January 29th all-time high. That's a 10.3% correction from the peak. In a broader bull market that has seen gold climb approximately 79% in the last 18 months, a 10% pullback is historically unremarkable. State Street Investment Management's 2026 gold outlook called for a consolidation range of 4,000 to 4,500 before any next leg higher. We've come in slightly above that. Deutsche Bank, Societe Generale, BNP Paribas, Goldman Sachs, Citi, all with targets between 5,000 and 6,000 by year-end. The CME's 9% margin isn't going away. The percentage-based system is a permanent structural change. Volatility will remain elevated. Expect more of what we saw in late January and early February. But also expect the underlying buyers, central banks, extending their purchasing into a 15th, 16th, 17th consecutive month, Asian retail demand, de-dollarization, capital flows to be waiting beneath the surface every time the paper market shakes out its leveraged players. The people who didn't understand margin mechanics in 1980 watched silver fall 70% and panicked at the bottom. The people who understood what was happening bought physical silver for $11 an ounce. A few years later, it was back above 30. The people who panicked in 2011's margin-driven gold correction sold at $1,600. Gold eventually went on to trade above $1,900 in 2020 and above $5,000 in 2026. The mechanism repeats. The leverage gets cleared. The fundamentals reassert. That's not me predicting the future. That's a pattern with 3 documented repetitions over 46 years. So here's what I'll leave you with. The CME hiked gold margins to 9%. Institutional investors pulled nearly $3 billion out of GLD in a day. Gold fell almost 10% in its worst session since 1983. The headline said, "Gold crashes." What actually happened was, the leverage in the paper market got cleared. The physical buyers absorbed the supply. The fundamentals, central bank demand, de-dollarization, U.S. fiscal trajectory, Fed rate expectations, didn't change by a single decimal point. And now we're sitting 10% below the all-time high, with every major Wall Street institution pointing higher by year-end, and with the structural drivers of this bull market not only intact, but accelerating. Understanding the difference between a paper market deleveraging event and a fundamental shift in the gold story is worth more than any price target any analyst can give you. The screen and the vault are telling different stories right now. History is very clear about which one wins over time. This is not financial advice. I'm not a financial advisor. Do your own research, talk to a professional, but do understand the mechanics, because the mechanics are where the real story is. Drop a comment and tell me this. Do you see this CME margin hike as purely a risk management move, or do you think the timing relative to the all-time high in gold tells a deeper story? I read every single comment. Your perspective genuinely shapes what I dig into next, and this community consistently spots angles the mainstream financial media completely misses. And if this video gave you something worth knowing, something that actually cut through the noise and helped you understand what's happening in this market, hit subscribe. 3 out of 4 people watching this right now haven't yet. You know where the button is. I'll see you in the next one.